Hello, this is Brian Rezny, president of Rezny Wealth Management. We have a great show for you this Sunday morning. Of course, we will be taking your questions. Please send those to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com. Look for our upcoming workshops that we will be having throughout the year. In addition, you can sign up for a consultation with my firm and also meet me in person to review your portfolio and make sure that you are truly on track and that the advice you're receiving is correct. You know, I want to talk a little bit about the economy before I get into today's topic. And one of the things that has come up just multiple times in the last year or so from not only my radio show but my TV show in addition is really the economy overall. Are we headed for recession? I have so many people send me emails or call the office in regards to, is there a recession? I keep getting these crazy emails that say the market's going to plunge 60%. It's going to be Armageddon, that type of information. Folks, I will tell you this. There's a lot of misinformation that come not only from Wall Street firms, but also from a lot of newsletter writers that you might get in your email box. At the end of the day, there's simple financial points you, the investor, can look at to see, are we really headed for recession? Is the market really going to have a major correction like we had in 2000 or in 2008 where the markets dropped 55%? Right now, we do not see any of that evidence. What we do see overall is simple. We see a slow-growing U.S. economy, and to be brutally honest, the U.S. economy right now, in my personal opinion, is the only place to be invested. We see a lot of turbulence and slowdown in some of the developed nations outside the U.S. and Europe. And again, some of the current terrorist attacks that we've seen or recent terrorist attacks have had some impact on their economies, and I think that we'll have slow growth economies going forward. The other thing that I ultimately see is, again, on the emerging market side, slowing growth, not negative growth, but slowing growth in the emerging markets. We're going to see some more volatility there. As an investor and as somebody who's managed money for about 30 years, right now, financially strong and relative strength on the upside has been really the U.S. marketplace. We've seen about an 8 to 10% correction back in 2015. We saw another one in 2016 at the beginning of this year. And again, those have both abated, and we generally speaking are back in this uptrend. Remember, folks, every single year the equity markets don't go up. And you will get one of these 8 to 10% corrections almost every single year, and you'll get 2 to 5% corrections multiple times throughout the year. It doesn't mean that the year is going to end negative, but ultimately you, the investor, have to realize you have to follow an investment strategy, and the advice you're receiving, is it real advice or is it sales from Wall Street or an annuity person who really doesn't legally work in your best interest as a fee-only fiduciary or as a money manager? Make sure you understand the difference, because ultimately you, the investor, really have to protect your own money and understand whom you entrust with your money so you're getting the proper advice. Complex investment products don't belong in your portfolio. This is one of the things I wanted to talk about on today's show, and the simple reason for it is this. Too often I find individuals or couples come into my offices throughout Florida, and they have these complex products in their portfolio. These complex products do not belong in your portfolio. They're generally sold by banks, Wall Street firms, and insurance agents who really care more about the ultimate commission they're going to earn versus your financial well-being. Because remember, most of these firms work under what's called suitability, not a fiduciary standard of care, meaning legally in your legal best interest. So complex products never belong in your portfolio. These are the products that are on my hit list, should never go in your portfolio. Variable annuities, expense-ridden, non-traded real estate investment trust, never buy them, folks. Fixed equity index annuities, or now they're called hybrid annuities, don't touch those either. Managed future funds, or funds that are called alternative investments. These are all concocted, complex investments with lots and lots of annual expenses that ultimately take away your return. One of the things that I try to educate every investor on is keep your portfolio simple. Utilize low-cost ETFs, exchange-traded funds, or base indexes in your portfolio. These complex products that, again, have been manufactured by Wall Street or insurance companies don't belong in your portfolio. Lots of expenses take away from your net return. I'll give you an example. If you look at a lot of the annuities that are sold today, they have annual expenses of 3 to 4% or higher. annual expenses. So imagine if you're making a 7% return and your variable annuity or maybe your equity index annuity has an annual cost structure of 4%. 4% comes off the 7% you made, so you're basically taking risk and volatility in your portfolio, but your overall return is being taken away by those incredible high expenses. Again, you make 7, you have expenses of 4, you have net 3% returns. That's pretty lousy when you have a very volatile portfolio, but most individuals do not do the research. They don't ultimately know what they're paying annually on their expenses because it's ultimately buried inside that prospectus and the internal cost structure of that investment. Expenses, and yes, more expenses. That's the problem with a lot of these investments. I often will get people will call my TV or radio show and say, Brian, but I never paid anything to buy that annuity. You may have not paid an upfront commission to buy that annuity, but you're paying on annual expenses every single year that come against your net return. Imagine having an annual expense ratio of 4% a year on one of your investment products, like a non-traded real estate REIT or a managed futures fund or some alternative investments sold by your Wall Street firm. 4% a year in 10 years, that's a lot of money. Think about somebody who has $1 million portfolio and you're paying 4% annually in expense ratio when you can build a low-cost basket of ETFs maybe for 10 to 15 basis points a year or less than 0.25%. 0.25%, 4%. You ultimately decide how much you want to keep in your pocket. Expenses ultimately take away from your return, and expenses are not your friend at all. The big news here is the fees and expenses are so outlandish on a lot of the investments sold by insurance agents, namely annuities, and Wall Street firms, a lot of these other products we talked about, they can actually wipe out almost all of your return on an annualized basis. I remember a report or an article that was written by Bloomberg about managed futures funds that are sold a lot by Wall Street firms, and some of these funds actually have annual expenses that often go as high as 10% a year. 10%. Imagine again, if your expenses are 10% and your returns are only 8%, you've got a negative overall return. This is possible with a lot of these complex investments. So you as an investor have to realize when you're being sold an investment, make sure you do your research first. The issue, Wall Street, banks, insurance companies or insurance agents like complex investment products. Why is that? Simple. It's better for their overall portfolio than you. Do your own research. Maybe that just means opening the prospectus, looking at that table of contents, and looking at what the annual cost structure of those investments you own are. If you don't ultimately know what the cost structure is, it could be sky high, and it could be putting your returns and your retirement in jeopardy. Remember, only work with a fee-only fiduciary. Never work under suitability, never pay a commission, never buy an investment that has a back-end sales load, never. And never buy complex products with a lot of crazy fees that take away from your net return because the only person that your portfolio should benefit is you, the investor. Tom from Cape Coral, Florida. What do you think about investing in Canada and the iShares EWC? Tom, great question. I would really avoid Canada. I don't think I've ever invested in Canada other than one Canadian bank stock back years ago. But Canada as a general marketplace, they are very dependent on oil, and I'm sure you've seen what's happened in the last year and a half or so. Oil prices have greatly come down. And the Canadian stock market, if I match up a Canadian stock market index against, let's just say, the S&P 500 index, the Canadian stock market index, or the EWC, has greatly underperformed the U.S. marketplace over whether it's a 1-year, 3-year, 5-year, or 10-year period of time. I would avoid Canada, and I would not even entertain looking at Canada simply because a lot of their indices are more oil-driven, and it's too centralized in one overall sector. I think you're much better off to invest in the U.S. marketplace, something like the S&P 500 or the S&P 600 small cap. Be diversified, utilize low-cost ETFs, exchange-traded funds. Most brokerage firms don't like them because they don't make a lot of commissions on them. And also make sure you find yourself a fee-only money manager or a registered investment advisor like Rezny Wealth Management, which can help you actually manage your portfolio in your legal best interest. Sue from Boca Raton, Florida. Stocks versus ETFs, exchange traded funds. Your thought, which is better, a better investment vehicle? Sue, that's an easy one. Hands down, ETFs or exchange traded funds. Why? First off, there's been many studies out there about mutual funds. Most mutual funds, and let's use the number, 80 to 90% of mutual funds do not even perform within line of the base index they track. As an example, you could take 2,000 different large cap mutual funds and look at their 1 year, 3 year, and 5 year track record and match it up to, let's say, buying an ETF that owns the S&P 500 market cap weighted stocks. What you'll find is 90% of the time this ETF actually does substantially better and outperforms it in almost every category. One of the reasons is slippage because of cost on mutual funds. A lot of research that comes from Morningstar, an independent rating service, says the average mutual fund has an annual cost of around 1.25% a year or so. The typical ETF that you can purchase and put in a solid portfolio might be 10 or 15 basis points. That's over 1% a year in cost savings. And again, if you don't know which ones to pick, you don't know how to manage that basket, again, find yourself a fee-only fiduciary money management firm like Rezny Wealth Management. Bill from Naples, Florida. My broker keeps suggesting a variable annuity for my IRA rollover. I know you don't like annuities. Help. Bill, I'm glad you asked that question. As you probably know, I do a 2-hour live radio show throughout Florida on Sunday mornings. Go to my website, reznywealth.com, for times and availability. But I'll tell you what, the number one question, the number one on my TV or radio show are calls and questions about very unhappy investors, Bill, that have been sold an annuity or multiple annuities. Annuities are complex products, whether they're variable annuities or these equity index hybrid annuities that are sold by, of course, insurance agents only. The bottom line, expenses do matter. And if you look at a lot of the variable annuities that I've reviewed as a firm over the last 30 years, a lot of these have annual cost of 3 to 4% plus a year. Those high costs take away from your net return. The only reason brokerage firms or annuity salespeople like annuities is the big, gigantic commission that ultimately pays them. That puts your interest at the back of the line. Annuities are sold under suitability, meaning the firm only has to sell you investments you're suitable to buy, but not in your legal best interest. Never buy a product that has a front-end load or a back-end load, and guess what? The annuity that you're being sold or being tried to be sold by your broker, Bill, is clearly a back-end loaded annuity. Do not buy an annuity, especially for a qualified plan like an IRA. It makes 0 sense unless you want to give a lot of your return away to expenses and cost to your broker and the insurance company. I'm going to take a short break. I'll be right back with more questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back, and I hope you're enjoying today's program. Of course, send your email questions to Brian Rezny at ReznyWealth.com. And please visit our website, ReznyWealth.com. You can sign up for instant email alerts about the economy, investment topics of choice. And as always, call our firm for a consultation. If you're concerned about the advice you're receiving, if the advice you're receiving is not working, if you're questioning really the quality of that advice, if your returns are lacking or you're not happy with what's going on in your portfolio, call us. Schedule a consultation. Let's do a review of your overall portfolio. Get that needed second opinion. Remember, your retirement matters. So does your portfolio. Make sure the advice you are receiving is the right advice. Call Rezny Wealth Management. You'll be glad you did. I want to go to my next question, and this is from Robert from Fort Myers, Florida. Do you use charts in your research and why? Robert, excellent question. Yes, Rezny Wealth Management, we do use charting, and the reason we use charts in our research is the biggest reason is a picture. A picture tells 1,000 words, and basically by looking at a chart, whether it's a chart of the S&P 500, whether it's a chart of a stock or a bond, ultimately, that trend is your friend. So by looking at a chart, you get a good idea which direction that investment is headed. There's also things like volume and different oscillators that we would look at as a firm, not to get too technical, but charting really can be helpful, especially if you're looking at adding to a position or potentially selling a position. Remember, I've talked about this repeatedly. Own relatively stronger investment sectors in your portfolio in a rising trend. Charts can help you point in that direction. And do not buy investments that are in a downtrend, and again, a chart can tell you that. A lot of investors do not use charts, and I think they're making a big mistake by not using charts. What they'll ultimately do is they might buy a stock and just look at the daily price. But by looking at a chart that's usually 3, 6 months, and 12 months in length, in different variations of that, you get a good direction of the uptrend or the downtrend of that investment. Remember, stocks that are in a downtrend could have deteriorating fundamentals, meaning earnings are going down. That is definitely a reason you want to sell. Never add to a stock that's down and in a negative downtrend with negative earnings. Big mistake. Rick from Naples, Florida. When do you sell stocks that you bought? That's always hard for me to know. Rick, generally speaking, I would say this. As an investor, and again, I've managed money for close to 30 years. I've talked to literally tens of thousands of investors through my different programs, TV and radio, and in person. I would encourage every investor not to buy individual stocks yourself. Managing individual stocks, doing the daily research that is required on an individual stock portfolio is labor intense. And most investors do not have the time, the discipline, or the talent to manage an individual stock portfolio. There's been a lot of research on individuals that buy individual stocks, and they do horribly worse than the base indexes. Utilize ETFs. Low-cost ETFs that you can be diversified, and generally you don't have to do a lot of research on those because you've got a broad basket already diversified. Owning stocks, your question about you didn't know when to sell or when to sell, most investors don't. They'll buy stocks they've heard of like Apple or Microsoft. When the stocks go south, they usually ride them all the way to the bottom, and when they're disgruntled and they've lost 60 or 80% of their money, 5 years down the road, that's ultimately when most people sell, when the pain is just too unbearable, when you should have sold 4 years earlier at a much smaller loss. Avoid individual stocks. It's hard to do for individuals, and most individuals I've talked to just don't have the time, discipline, temperament to basically handle an individual stock portfolio. Utilize ETFs, more diversification, less whipsaw, better chance for returns on your money. Pamela in Estero, Florida. What do you think about retirement investment plans for people who don't have a lot of background about investing? Example, the Vanguard 2045 or 2050, etc. Pamela, excellent question. What you're talking about are target date funds. Vanguard has them. There's a lot of mutual funds that have what's called a target date fund. All a target date fund is a preset asset allocation based upon a magical date in time, like let's say the 2045, meaning you would be retired in that time frame. So as you get closer to 2045, that portfolio adjusts its allocation accordingly based upon your risk tolerance or what they think you should be as you get closer to retirement. I do not like target date funds. I would rather have you build your own allocation with proper investments. And the reason I say that is most of these target date funds have higher overall annual cost, and it really kind of boxes you into the stock allocation. And not everybody should have 60% in bonds and 40% in equities, even at the age of 60. You might want to have more equities or more bonds depending on your risk profile and goals and objectives. But these programs, it's more kind of like, hey, let's kind of, instead of you pick it from the menu, we'll kind of give you a standard item on the menu, which may not be the best for you. I'd rather have you do your own allocation. If you're unable to do that, find yourself a fee-only fiduciary money management firm that can help and assist in that manner. Jerry from Naples, Florida. The stock market has really rebounded in the last few weeks. Do you think all the recession fears heard by Wall Street is overblown? Jerry, I like that question, and I'll tell you why. We have been inundated at my firm and my TV and radio shows with questions about recession and all these crazy like emails people are getting from newsletter writers about stock market crash imminent and a 60% crash coming next week and this kind of stuff. Bottom line is this. A recession usually comes around when you have a major slowdown in housing, which we do not have, and a major increase in unemployment, which we do not have. Now, there's more things that we look at as a firm, and we pride ourselves on doing quality research, looking at recessions or for a recession, and then hopefully, obviously reducing risk well before it. But at the end of the day, look at two main areas. Housing, which is a big driver of the U.S. economy. It's in a nice uptrend. Remember, I talked about charts earlier. Look at unemployment. Unemployment levels are going down, meaning more people are working and wages are starting to go up. These are not signs of recession. I think a lot of investors overblow recessions, and I think a lot of Wall Street firms and newsletter writers like to cry recession because it gets people to do a lot of crazy stuff with their portfolio that ultimately leads to more commissions for those firms and less money in your overall portfolio. But I will say this, if a recession starts rearing its ugly head, then you do want to reduce equity-based exposure. We currently do not see any signs of recession. If we do, we'll try and alert you the best we can. Tim from Cape Coral, Florida. Where are the best opportunities in preferred stocks? Good for income question. Kind of two questions, Tim. Number one is this. Preferred stocks are a hybrid of common stock. They usually pay a higher dividend structure. If you look at preferreds, though, Tim, they act very much like long-dated bonds. While Janet Yellen, the Fed president, essentially said, hey, we're going to raise rates fairly slow this year. We're going to be methodical. We're going to watch the data. I think rates will go very slow this year, maybe one or two more times a quarter point. That's going to be it. But with that said, if rates do start moving up over time, preferreds can come down in value. So remember, they are a stock. They can have a lot of volatility like the stock market. Yes, they pay a little bit higher dividend. You got to ask yourself, though, can you handle the volatility in order for that little bit higher dividend? If you are going to buy preferreds, I think the best way to do it would be an ETF, an exchange-traded fund, the iShares PFF. Again, that symbol PFF. Do your own research on it. This buys a broad basket of preferreds. Again, decent dividend payer, but you're still going to have some volatility with the overall market itself. Jeff from Miami, Florida. The S&P 500 death cross, time to panic. Jeff, I've had that question a number of times, and let me explain, folks. This again goes around charting, and I talked about that earlier. The death cross is this. Let's say you have the S&P 500 at this level, and the S&P starts going down. There's something called the death cross, which is the 50-day moving average against the 200-day moving average of the S&P. If the 50-day crosses underneath the 200-day moving average, meaning prices are going down quite swiftly, that may be a time to panic and sell your portfolio of equities. I do not believe in the death cross. In fact, there's been a lot of research on the death cross, and actually, as long as you're not in a recession, meaning the economy is slowing down and rolling over, which we don't see now, Actually, a good time to add new money to your portfolio is when you get the death cross on the sell side, and actually sometimes you want to actually reduce exposure to equity is when it crosses back to the upside. So it's almost counterintuitive, counteractive to what people actually think you should do. Again, recession's one thing, but if we're in a growth economy, which we clearly are, the death cross, time to panic, absolutely not. Tim from Naples, Florida. Can you explain how bonds work, please? I find them very confusing. Tim, bonds for most people are a little bit confusing, but think of a teeter-totter when you were a kid. When one end goes up, the other end goes down. That's basically bonds. So if interest rates start moving down, bond values actually go up in value, meaning you make capital appreciation. They can actually kind of act like a stock, meaning stocks go up, you make money. If interest rates come down, remember, bond values start moving up because your bond's worth more money. You could sell a bond before it matures and make a capital appreciation. I think most of the big capital appreciation anyway in bonds is pretty much done. Remember, we've had almost 20 years of interest rates in the U.S. going down, 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 down. If I look at the 10-year Treasury right now, we're about 1.8%. Sure, it could go to zero like other countries. I doubt it unless we really have a slowing economy and the Feds push rates even further down. I don't see that currently. That could happen in the future, but right now I see rates fairly steady, slowly moving up as long as the economy stays stable. But at the end of the day, own short-term duration bonds today because rates are low. If rates move up, your bond values, remember, go down. Teeter-totter effect. Ted from Boca Raton, Florida. What do you think of closed-end mutual funds? They seem to pay high yields. Great question, Ted. Closed-end mutual funds are much different than an open-end mutual funds that we talked about earlier. A closed-end fund basically issues a certain number of shares. The problem with most closed-end funds is this. It's called leverage. A lot of closed-end funds deploy leverage, meaning they borrow money to juice up yield. So that's number one. Number two, you mentioned the high yields that some of these closed-end funds actually give. Some of that actually comes from return of principal, meaning you're getting a distribution, not pure income. So don't think just because you buy a closed-end fund that's paying a high yield, that actually might be a distribution. Some is actual dividend or yield, and part of it might be return of your own money. As an investor, don't buy investments that are returning your own money and think it's actually a yield because your value is going down every year. You might be getting a high yield, but your overall return is very mediocre or even possibly negative. Folks, I'm close out of time. If you have concerns about your portfolio, is it performing the way it should to meet your goals? Are you truly happy with the advice you're receiving? Schedule a review, consultation with my firm. Get that needed second opinion. Call the number on the bottom of the screen. Make sure you visit ReznyWealth.com. And as always, we are here to help get you back on track. Call my firm now for that second opinion consultation. Get your portfolio back on track. Never settle for bad investment advice. Your retirement is too important. I'll see you next week.